Hi, everyone. Good afternoon. Welcome to LIBOR's Wednesday webinar. My name is Mary Ann Monteleone, Vice President of Professional Development for LIBOR, and we're thrilled that you are here with us today. Our program is a follow-up from one that we did a few months back, and back, I guess, by popular demand, is the same program, but only looking at 2023 and beyond, from Wall Street to your street. And to lead the program and introduce our guests, we have Andy Thor here with us, who is Senior Vice President for Jet Direct Mortgage. So welcome, Andy, and I turn it over to you.
Thank you, Mary Ann, and I appreciate having us back again. I always enjoy these events because they do tend to be timely. And as we were talking about just earlier, and I was just talking with Terry, the last time we did this event was at a very important day, whereas this afternoon we're coming out with some important data that we've all been waiting for. So, so maybe next time we should schedule the day after, I think, so we can see where we're at and kind of take it from there, or certainly a follow-up, that's for sure. So if you were attending the last event we did with Wall Street to Your Street, the thought process and the concept that we did here is that as agents and realtors and brokers, obviously your strongest partner in your development and the closing transactions, and just your industry partner hand in hand, of course, are your lenders and your lenders in the community. And basically, a lot is known in a lot of classes out there and presentations about how we function, or how the lending community closes transactions and how we do mortgages. And a lot of the events out there have to do with qualifying and maybe an appraisal or whatever it may be that we do on an everyday basis. But one of the things I've always liked to focus on is getting past what I used to call a culture of when culture is what I said last time. And Steve, you could relate to this, I'm sure, where we had decades where our companies were like, well, tell me what to get and when do we close? You know, that kind of approach to lending. But we found that over the years that it goes way beyond that. And the whole point of the Wall Street to Your Street is not only to bring where our climate is right now from coming right from Wall Street, but the point is that what I'd like to do is to then take it steps further in not only what do I get, when do we close, but important to understand the why of it. And anybody who's been a long time successful in this trend, in this community, understands that you really have to understand the why of everything that we do. As a past educator in my life, okay, I always knew the importance of understanding the why, so that the what and the when takes care of itself. And the last component of that, of course, is how do we do what we do? So part of that understanding the why of what we do in lending has to do with how we relate to right from the very beginning, or where everything kind of emanates from, and that is Wall Street. And everything that we do from a credit policy or monetary policy stems from the relationship that was instituted way back to create what we call the secondary market, or when our agencies were born, the GSEs we call them, or everybody understands what Fannie Mae and Freddie Mac is, of course, FHA, what have you, which we'll expand on. But it's that relationship with the GSEs and the agencies that go right to Wall Street, in that we all know on the surface that loans get closed and they get sold and blah, blah, blah. But we never truly understood the mechanics of it, how connected we really are to that environment. So that's really the premise of why we started this Wall Street to Your Street, because everything specifically goes right from attracting investors who then actually purchase those loans, and how they securitize them, and then attracting global investors to propagate the funds that we use on an everyday basis for mortgage lending. And that's why we created this. And to those ends, everything is very connected to that. And I would say this year, of course, in 2022, we all know the headlines, and we know how volatile this industry has become based on what's happening, of course, in the headlines, and based on what's happening with the financial sectors. And that's why these events become so timely about that. To those ends, to present today, I brought back our friend from Wall Street, Terry Gardner, is a partner over at CJ Lawrence, and he's a portfolio strategist, I believe, for approximately 30 years. He is award-winning from Bloomberg in the past, and really a true handle on what's happening within our markets. And I've seen his own blogs coming back into that industry, and he did a wonderful event just recently talking about the seesaw of what's happening right now. So bringing back Terry, I'm going to be turning it over to him shortly, kind of to talk about what's happening within our financial sectors, which then, of course, then trickle down to our industry as well. We have a wonderful industry guest here. I'd like to introduce Stephen A. Milner. Stephen is the CEO of U.S. Mortgage Bankers, and we go way back, Steve, I guess about 25 years, possibly 30 years. And we have a lot in common, and that is that we're both educators as well. And Stephen had if I remember correctly, a career in the education arena as well as I did, but I think you lasted longer than I did. But but Steve is also not only a fellow banker, but he has built a phenomenal company that's now nationally known, and has also been extremely active within our industry when it comes to legislation, what have you. And I believe you were president of the New York Mortgage Bankers Association previously, correct?
Right.
So Steve, introduce yourself a little bit. Tell us about what you've been doing with your company and where you're at, and then I'm going to take our event. So just why don't you say hi to the crowd and tell us what you've been doing.
Well, thank you for that introduction, Andy, and thank you for everyone, and thank you for inviting me to this to Wall Street to your street. Sounds like a compelling webinar, and I very much look forward to participating. My history goes back. I've been in business 42 years. I started in 1980. I grew up on Long Island. I was a school teacher, and then I got into the business, just to make ends meet, so to speak. And I left teaching in 1986. I opened up a mortgage brokerage company in Bayside, Queens, and as a mortgage broker. And then in 1994, I opened up U.S. Mortgage. The founder and the CEO. I have no investors. That's just me, and we are a license where I received my New York State license as a mortgage banker, which is very difficult to receive, to obtain. I'm sure Andy can relate to that. Took me about 2 years to get approved, and we've been operating as an independent mortgage banker we're going on our 29th year now. February 17th, 1994 is when I opened up the company in Bohemia on Long Island. And our business model has always been the self-sourced, self-generated, referral-based purchase money business model. I was very fortunate to avoid the implications of the recession in the late 90s, early 2000s, because I basically stayed away from the subprime loans as a lender. Many of those lenders who engaged in those subprime loans are no longer with us, as you know. And then in 2008, as many of you know, the SAFE Act was passed, which required loan officers to become licensed. So I took the initiative to become licensed as a loan officer in every single state. I have 51 MLO licenses. I think I'm the only CEO in the country that's licensed as a loan originator in every single state. I had to take 51 tests, just so you understand that.
And that's interesting.
It took me about 2 years, but that enabled the company to become licensed as an independent mortgage banker in every state. So we are currently licensed in every state, and our business model is a branch-based, self-generated, referral-based purchase money business model. We do about 95% of our business is purchase money. As Andy indicated, we sell directly to Fannie Mae and to Freddie Mac, and we do every possible loan, FHA, VA. We do a lot of renovation loans, which of course is Andy's specialty. I really love that product. I think it's great for realtors. We actually specialize in educating realtors on how to educate their consumers, because I think that's important, either on the listing side or on the buy side.
All right.
We do about 1.5 billion. Last year, we're only down about 30% this year. So we should hit probably 1.1 billion this year.
That's great.
And we have about 400 employees, and we have, I think, 38 branches throughout the United States, so in different parts of the
Right.
country. So that's basically an overview of, so
Stephen mentioned a number of things that I'm going to circle back to in discussing that. First of all, knowing how to ride different cycles, and we can all understand that everything is cycle based or even counter cyclical in that nature. And a true success is that really understanding how to read those cycles and how to come out of it. And that is part of the discussion today, bringing it back more specifically in that is that the lending community, unlike many other years, is that everything is happening on such a fast pace right now. And the challenges that we face are so different. I'm going to say they're historic based on other years, in that the changes, the interest rate jump and everything that we're experiencing, it's much quicker than it ever used to be. And so it's not necessarily the movement of where the markets are going. What's happening is it's the quickness of what it's happening, so that any kind of a forecaster or a planner when it comes to monetary policy and therefore I'm going to say credit policy, it's very difficult to project outward. So we're kind of approaching it on that step-to-step basis. But the one thing I will say is, Steve had mentioned the difference of a brokerage becoming a banker, and I'm going to kind of take that over next before I turn it over to Terry. But the bottom line is longevity means you understand the markets and how to adapt. And the good news is that the headlines may be painting doom and gloom, and it's awful to turn the news on. But the truth of the matter is every successful player, whether it's in the lending community or real estate community, understands these counter cycles and really how to adapt. And that's really what we're doing now. And that's why we really felt, especially in the headlines recently, we wanted to bring this Wall Street back, because it's happening again. And here we are in this cycle. We forecasted a few months ago, but now let's see where we landed and hopefully set the tone going forward. So I am going to circle back to that, Stephen. You'll see where I go with this. And Terry, I'm going to start with you today. So I'm going to paint the relationships of what's happening. But before we do that, I wanted to get Terry to speak and hand it over to him. And I'm very grateful you joined us today. I hope you're feeling well. And so talk to me about the Wall Street thing. I'm going to turn it over to you, because we're all kind of in anticipation. And I understand you don't have any insider tips before I get on my portfolio. But with that said, I'll turn it over. So everyone has met Terry before, but he is a wonderful, not only human being, but certainly has an amazing background in Wall Street as a strategist as well. So Terry, take it away. It's all yours, my friend.
Sure. Thanks, Andy. And great to be back with everyone. It's certainly interesting times, as Andy mentioned at the beginning of the presentation. Here we are again, having this get together on Fed Day. So we're all kind of watching the TV to see what the Fed does with the Fed funds rate this afternoon. By way of background, briefly, again, my name is Terry Gardner. I work at a firm called CJ Lawrence out of Manhattan. We're a boutique investment manager. I manage client portfolios. My clients are individuals, families, some foundations and endowments. And what's unique about CJ Lawrence is when we build our portfolios for our clients, we build them from the bottom up. So we don't necessarily buy funds to incorporate into our client portfolios. We buy individual securities. And that's particularly pertinent to today's discussion, because I'm buying individual stocks and individual bonds for my client portfolio. So I'm watching the movements in interest rates very carefully and trying to figure out the interrelationships between stocks and bonds as I reweight my clients' portfolios. And it's particularly challenging given the backdrop, the macro economy, in trying to forecast where markets are likely headed. We're having this tug of war now in the consensus and the general belief as to whether the economy, there's a camp suggesting the economy is going to be just fine. Inflation may be a little stubborn, but growth will stay intact. versus those who think that the economy's headed towards recession. And you can see that playing out in the bond market, whereby the Fed here is likely to raise interest rates, the Fed funds target rate, another 50 to perhaps 75 basis points. The consensus is that they'll slow down to 50, to a rate that's closer now to 4.25 to 4.5 on a target rate. But interestingly, the 10-year Treasury bond benchmark, which I think you're all watching, given how closely it's tied to mortgage rates, is below that level, right? Right around 3.5. So we've got this really interesting dichotomy where we've got an inverted yield curve, where the 10-year Treasury is trading at a lower yield than where short rates are. And what is that telling us about the markets, the bond market and the stock market? Usually, an inverted curve leads to a recession. So we're looking to see how that plays out. And importantly, as I mentioned earlier, how challenging and confusing this market is. This was one of the first years where we've seen what I have been calling the broken seesaw. So where in most markets, you see either stocks or bonds doing well versus the other asset class. So when stocks do well, typically bonds underperform, vice versa. If stocks are underperforming, bonds can provide that cushion and or a little lift to your portfolio. And that's where the genesis of the 60-40 portfolio came from, balancing out stocks versus bonds in your portfolio. Well, this is one year where both asset classes have just really cratered. Stocks have performed badly and bonds have performed badly. And I was looking at some recent figures. This is the Treasury bond index, the Morningstar 10 plus years, so maturities 10 years and out. Treasury bond index was down 29% on a total return basis this year. That's really remarkable, given given that corporate profits have been okay and the economy's kind of held in there. So net, we are in my business, in the investment business, struggling to figure out how all these macro events play out and what that means for our stock and bond portfolios. So I'll turn it back to you there, Andy, with that intro.
Terry, you said some interesting things, and I'm going to bring Steve into the conversation. As far as I've always been understanding, looking at the yield curves, again, when you have an inverted yield curve, in that how it applies to our industry is that the longer the term you would apply to an interest rate in our community, typically, historically, the higher that rate would be. So therefore, a 30-year fixed rate historically would be a little higher in nature than a 15-year fixed rate. Or then we came up with, at some point, with hybrid loans where you would have a 10-year or 7-year or 5-year fixed rate. But the bottom line is, the longer the index went, typically the higher it went. But for many years now, I'm not sure when it started, that inverted yield curve made it so that the longer term rates, the 30-year rates, far outperformed and were more attractive than short-term rates. And as you just said, we're both tanking right now. So that how do you respond to that? Well, we have to see where the Feds go. But correct me if I'm wrong, but what drove this a lot, I'm going to bring Steve into the conversation, is that when one segment of the market was behaving badly, you would have a massive sell-off. Do you remember what we used to call a sell-off, which then drove? So it's not necessarily what the Feds did, it's how the markets reacted to that. And if it created a sell-off and went to a long-term index kind of issue, that would drive the prices up, which drove the rates down. So it's that sell-off tradition that affected us as lenders of the kinds of programs we're going to offer, or what's better for a consumer. Steve, and I'll ask you again, we've been around a long time, and I didn't realize you were so much older than I didn't know that, but okay, I'm joking. But Steve, any thoughts on that? We knew good old 30-year fixed rates, and we had good 1-year adjustables, but when everything inverted, everything kind of changed. But now we're in that market, like, what do you offer? Do you offer the 30-year? Everyone's talking about buy downs and adjustable rates, but I don't see them as being that advantageous right now. Any thoughts?
Well, as Terry was saying, I mean, I think a lot depends on what the direction and objectives are of the Federal Reserve. Today, they're going to raise the rate, the Fed's fund rate by 50 basis points, but their target rate to control inflation is between 2 to 3%. And personally, I think that Mr. Powell at around 2:30 today will indicate that he's still on the path to to decrease inflation. Because I don't think he's he's not near that amount. I think we're still at 7.7, something like that. But more importantly, he's very much focused on the unemployment rate. He feels that if unemployment could increase, I should say, unemployment to 5 to 6%, and currently it's at about 3, then that will curtail inflation. More people unemployed, what happens? Demand drops, prices come down. And that's his goal. And I think that's even more important than the direction that inflation is going. But I think personally that the Fed will hit their targets on inflation and on unemployment, I would say by the second quarter of 23, somewhere between April and May of 23. And I think that will result in, as it relates to mortgage rates, hovering around between 5 to 5.5%. So I'm kind of optimistic about it. And if that occurs, then I think from a real estate standpoint, I'm kind of optimistic. I think we'll see more of a buyer's market as opposed to a seller's market as it is
Right.
now, and as it has been in the last year. And so I'm kind of optimistic and positive about that. And from a mortgage banker standpoint, all the loans that we're doing now at 6.5 to 7.5%, I think they'll be good refinance candidates, to be quite frank. So,
Yeah,
I've been through these cycles many, many times in the 80s, the 90s. And I always say a tree does not grow straight to the sun. And we're just going to continue to see cycles like this. The real estate business and the mortgage business, as I call it, is a cyclical business. And we will continue to see these cycles as the economy continues to, have their change, as the economy continues to change, which is why we have a Federal Reserve. But I'm kind of optimistic about it, and some people may think I'm a little crazy, but I think we'll be settling in between March and around April and May of next year. And those entities, those realtors, those mortgage companies who can withstand possible fluctuations in their operational costs will come out ahead, by the Q3 of 23, in my opinion.
yeah, I definitely agree with the optimism, Steve. Honestly, the way I look at it and the way things filter out, I think if the Feds are accomplishing a softer landing, let's say, hopefully where we're going to land at a certain point, I'm thinking that the indexes right now should be able to get us into the 5s, but the going back to Wall Street and going back to the investors who are ultimately securitizing these loans, they're a little afraid to set that monetary tone, so the
Correct.
profitability they really should be lower than they should, but everyone's afraid to forecast and offer that profitability to the lending community just yet. But I think once we've arrived at the steps and get soft a little bit, we'll see a little bit more normalcy. So you as a lender, especially as a servicer, which I'm going to talk about in a moment, will be able to then make much better decisions in going forward in your not only your pricing policies, but even credit policy for that matter. Because by assuming risk for much less profitability, it creates a different dialogue from within. I'm sure that's something you look at all the time. And I also think that's why a lot of the bigger national banks, I think we're going to see a little shrinkage in that their portfolios are going to maybe have a little bit too much risk in their profit margins. So as profits shrink, possibly we're going to see an erosion of the bigger banks. And I think the national groups are looking at the independent mortgage bankers at being a much bigger player as we have been for many years. So, and I want to remind everybody out there just a little bit about the relationship. So let me just, if you remember the slide, I brought this in last time and that I was using just to kind of paint the picture. Basically, we have different levels here. And as I mentioned last time, obviously we have our home buyers and everything goes right to our consumer. And what we spoke about last time is that if you look at the kind of this little breakdown here, is that the originating sources, as I kind of painted this here, is obviously the source for a consumer was our banks, of course, our commercial or SNLs or community banks, mortgage bankers, independent mortgage bankers that really do a much bigger percentage of the business, such as what Steve is, independently owned, credit unions, and of course, then we have mortgage brokers. Now, so obviously we have our level of here, what we call originating sources for mortgage money to the real estate community. Well, this is our sources. So now what happens is, if you remember, everyone talks about how we sell loans off and we do loans and we do a loan and we sell it off and all that. So if you remember it doesn't just magically happen. Companies like Steve, what I'm involved with, and your lenders around the country, in order to function the way we do, okay, we then have to enter into contract of various sorts in that we have relationships. Let me just pull this up here. Hold on. Draw. We have these relationships that we establish with the sources of where we do sell our business. So for instance, if you're a banker, all right, I'll focus on the independent mortgage bankers, you may become approved directly to take your loans and sell it to Fannie Mae directly. That's what Steve was talking about, being able to sell directly to Fannie Mae, which are the agencies. Everybody know what they are, and everyone's heard of Fannie Mae and Freddie Mac, who ultimately then will securitize these loans, or they call them tranches, they call them, not to get that technical, and ultimately get to Wall Street. So what happens is, if you remember, the sources like your mortgage bankers will then become maybe approved with Freddie Mac because they have different programs, and I'll get to that in a moment. Then they have different sources where there may be other banks that they can sell loans to, or they may have products to build a credit unions, or possibly what we call portfolio or hedge fund driven companies. And what we're getting at here is that as a mortgage banker, or even as a bank, like whether it's a Chase or a credit union or whatever, what's happening is you have these intertwining contracts that are done, and not yearly. I believe they're done yearly. And what we do is we deliver them contractually to these entities so that we know where we can sell loans to. Okay, because ultimately what's going to happen is these entities, whether it's a GSE like Fannie or Freddie, or independent bank or credit union, or the portfolio hedge fund companies that typically drive things like no income check loans, or we call them non-QM loans, where if you remember in the beginning, as Steve was mentioning, he stayed away from it, but the subprime territory, which I did too, by the way, everyone remembers those days, no income, no assets, no kidding. Yeah, we all remember those days. But what happens is, we all know that eventually they all get securitized to Terry, Wall Street. So what's happening here is, ultimately speaking, it's the appetite of the investors to Wall Street that attract the global community to invest in these securities, that then drive the aggregators, we call them, who package these loans. Of what loans? The loans that were originated by the originating institution. So it's all these contractual terms that we have as bankers, as independent bankers or credit unions. The sources for a consumer go to their sources, okay, who then ultimately sell them, okay? Or you have another level. You have a level where Steve had mentioned that he is, in that you can be a mortgage banker and securitize it and service it directly to Fannie Mae, right? You can create your own mortgage-backed securities, whereas other bankers can't. So it depends on your level of your approvals contractually that you have with your sources to sell loans to. Now, what does that mean to the real estate community? If you remember, what it means is, it's great that you had your different relationships, and what you want to have is that the sources that consumers go to have the products or the types of let's forget interest rates for a moment, but the different products that the consumer would rely on in order to get an approval. Now, I'm going to circle into that in a minute, and I'm going to turn it over to Steve, is that once we sell these loans, they dictate policy, okay? And everything is always comes down to risk. And what happens is we're so statistically based at this point, all right, in that basically Fannie Mae, for instance, sets out their criteria, if you will, of the guidelines that we follow, so that if you originate a loan as a mortgage banker, you're following Fannie Mae's guideline of what we're going to offer to a consumer. What I mean by that is they require, let's say, 5% down, and they want credit scores of 640 or better. We've all heard of those daily things. We all are understanding that. But what it ultimately means is that Fannie Mae has come down and told their institutions who sell them their loans, okay, we'll securitize your loans, but this is the level of risk or what we see when it comes to looking at a particular file and or a portfolio in the big term, because what happens is once we sell it to Wall Street and securitize it, we're on the hook for that loan. They have to make that payment. So what's happening is they're on the hook. So therefore, we have to be on the hook. Everything filters down. So what do? They set the tone of how they're going to lend them, what they want to see in that particular file from that consumer in order to purchase that loan. And it's global, but then it filters down very individually. That's why it's incumbent upon a good lender to have your different sources, so that Freddie Mac, for instance, if we sell to Freddie Mac, might have different credit criteria as compared to a credit union, et cetera, or selling loans to Fannie Mae, okay, et cetera. So the point is, that's kind of what drives it. So that with that said, a home buyer, a homeowner looking to purchase a home, you're going to see what kind of product that you've all heard of. Call us, we have 100 products, we have the product that's right for you. Well, what do you mean right for me? What it means is how we are able to approve you based on underwriting criteria. And now what's happening is we are loan providers, if you will, whereas a mortgage broker per se, okay, does not provide loans, they arrange for loans, okay? So then a consumer, let's say, can go to a mortgage broker who then would not sell off, but actually provide the loan to an originating source who then securitizes it. So you have 1, 2, 3. That's why they call them third-party providers. So these are your sources. This is what sets the tone. And the tone that I'm referring to, okay, all comes down to, hold on. I think I have to clear this. Yeah, there you go. Come on. Bear with me. Clear all drawings. Not sure why it's not advancing. Whoop. Hold on one sec, guys. I'm just going to bounce back. Give me one more second. I'm not sure why that happens. I'll figure that out. Okay. There we go. So this is where we're landing here. And so what I did was, now based on those relationships, that everything stems from the Wall Street sources that we have to securitize those loans, which is where Terry comes from and his whole community. Then how it filters down to the lending community in the ways that I just demonstrated to you, in that we have, as lenders, contractual terms to sell our loans off to various entities, all right? And there's different ways you can do that, whether you keep the loan to service it yourself, which Steve will talk about a little bit, or sell the loan totally. Either way, what's happening is when you have cycles that we're in here, my point is, or counter-cyclical cycles, which we're going to see, all right? Everything then comes down to what I call your risk-based pricing, or assuming risk and what's it going to cost in order to do that. And also indirectly and directly, credit policy gets shaped, okay? Because every time we see a year worth of default statistics and what have you, their agencies like Fannie Mae or Freddie Mac tighten the belt if they see a particular sector where there are defaults. And this is where everything is shaped. And that's why in this quickly changing environment, where it's very important that your experienced lenders see what's happening so that they can adjust. And that's where companies like Steve and myself have been around a long time, can read that cycle and say, okay, how are we going to be lending for 2023? I am optimistic, but to be optimistic, you also have to be prudent, all right, so that we're providing good financially sound products to the consumer. So Steve, you can see this layout here if you look at all the different things that come into play. I'd love you to get some bearing on this. And guys, this is the first time Steve is seeing this slide here, but I think it really encapsulates everything that we think of on an everyday basis. And again, I always like to say, this is Terry up here. That's Terry's office right over here, just in case. But Steve, look at the intersection between our pricing and our interest rates compared to credit policy. And I'd love to have your thoughts on it.
Well, that's, firstly, I want to say I have the same exact picture in my office. And
Oh, is that true?
I have in the background, kind of interesting.
Oh, that's
Yeah,
funny.
so, so Fannie Mae, as many, just as a point of information, Fannie Mae was established in 1938 and Freddie Mac was established in 1970. And basically they set the tone and they set the requirements for by which loans should be underwritten and approved. And independent mortgage bankers like myself have to process and underwrite and sell the loans to Fannie or Freddie Mac in accordance with their underwriting criteria. And as Andy pointed out, there's risk associated with that in the event the loan is not underwritten properly, and upon doing a quality control, which they do on every loan at some point within the first 3 years of purchasing a loan, they will require the seller, in this case the independent mortgage banker, to buy that loan back, and then they either have to service it or sell it at a discount to an entity that will pay a discounted price for that loan. And that's the risk an IMB has. So there's a certain amount that goes into computing the pricing of a loan when the loan has to be sold to Fannie Mae or Freddie Mac. Now, there are IMBs that do not sell the loans directly to Fannie Mae and Freddie Mac, and they have to incur what's called loan level pricing adjustments, meaning that they sell the loans to what's called an aggregator, and that aggregator then sells the loan to Fannie Mae or Freddie Mac directly. For example, in our case, we sell about 20 to 23% of our loans directly to Fannie Mae and Freddie Mac. The other 60 or 70% we sell to aggregators. And when we do that, we actually get a better price when we sell to the aggregators. But then the reason we receive a better price is because they're going to realize the value, which is called the mortgage servicing rights, the MSR rights, as it's called, when they sell the loans, and it becomes an asset. So it's a combination of both, and there's a certain amount of factors that go into the risk-based pricing, which impacts the credit policy that a mortgage company has. Some companies are more lenient than others. They're willing to take the risk. Some are not. Personally, I've always felt that it's pretty simple to me. A borrower must demonstrate the ability to repay the loan and the willingness to repay the loan. And unfortunately, in the late 90s, early 2000s, during the Clinton administration, when they wanted to increase home ownership from 63 to 73%, that caused the evolution of the subprime era,
Right.
which ultimately led to the Great Recession. And that's because the government condoned even Fannie Mae and Freddie Mac to purchase loans where the borrowers did not have to demonstrate the ability nor the willingness to repay the loan, i.e. the evolution of the subprime loans. I've never believed in that. And I've always felt that everyone is entitled to a roof over their head. That's our simple belief here at US Mortgage. But not everyone is entitled to a mortgage. And that's the kind of philosophy I exude throughout the company.
Yeah, Steve, let me just jump in for a moment. So to paraphrase what's happening is, one of the things you said was that taking on that risk by selling that loan off, and what that means to a consumer for one of the purchases you do for a real estate agent is that you, of course, you want to close it. you want to get the closing, you want to do business or whatever, but by making that decision, the responsibility is that you want to create something that's affordable and sustainable for the consumer. So it has to be more than just the closing. So what happens is by selling that loan off to an aggregator or Fannie or whatever, what Steve is saying is that he mentioned something and it's called the repurchase. So that if that loan defaults, let's say an early payment default, or there's different criteria, the aggregator or the purchaser of that loan, they're going to do their due diligence of that loan. And they're going to then come back to the lender and say, hey, why did you do this loan? Okay. And there's always the risk if it defaults that what Stephen is saying is that that lender has to then repurchase that loan. All right. So if you lent a $500,000 loan to somebody and they found to be an error or if it's defaulting, it's a very hot topic where they have to repurchase. We want around $500,000 back. And then what Steve is saying, okay, now I have $500,000, I'm out. Now we have to do, what do we do with it now? So somebody else is going to buy that for $400,000. Well, I'm out $100,000. That's where the risk is what I'm talking about is. And that's why there are some lenders who would do a loan and maybe some other lenders won't, and you mentioned another thing that set the tone after the industry blew up and way back in that recession area after the subprime is that the QM ATR rules came in. And what lenders are now lending is that the feds came in, and I've always said this, you never want legislators regulating, that's for sure, but that's kind of what happened. So they created that QM ATR rule, and Steve had mentioned that ability to repay is what we're talking about. So that there's different guidelines that we have to make sure that a consumer has the ability to repay. Now, what happens is they created, what they did do on a good level is that they created different categories. And one is what we call a safe haven, all right, whereby, and Steve can expand on this again, because we're moving on here, but it's important to understand that, is that if they came out with guidelines of what they would call, what we call a QM or a qualified mortgage, that has to do a lot with the terms of the mortgage, and it said like no interest only, with fixed rate rates of more than 5 years or 10, or I should say a 30-year fixed rate. Anything different, those others, they become non-QM mortgages. But more importantly, also is the ATR rule has to do with how the loan is underwritten, and how we approve loans means that one of the factors has to do with if we underwrite a loan, let's say to get your loan closed. And let's say the ratio, for instance, is over 43%. Okay, and I think that's been relaxed a little bit lately. I think is that if that loan was under 43%, and if the lender did everything they were supposed to do as set out by the QM ATR rules and by Fannie Mae and Freddie Mac and what have you, and documented the file, that's so important. Why we process the loans the way we do. Okay. That if it defaults, unfortunately, God forbid it defaults, they're going to look at that file. And if we did our job, we have what they call a safe haven. The lender did great. They did a great job. You're safe. Okay. But if we expanded those guidelines because we were doing a good loan, okay, or maybe we shouldn't have done the loan, then you have what we call a rebuttable defense, meaning that that source that purchased the loan will go after the lender to say, hey, we see that you did not follow these rules. We want you to repurchase it, but we'll give you 60 days to let us know why you did the loan. Steve, am I kind of defining that correctly?
Yeah, and very good. I also want to add that as a seller to Fannie Mae and Freddie Mac, you are still subject to repurchase the loan, even if the loan is performing.
Right.
It doesn't. If the loan is performing, it could be years after the loan has been purchased, and during a quality control of a random quality control of the file by the agency, meaning Fannie or Freddie Mac, and they find that the loan was not underwritten in accordance with their guidelines, even if the loan is performing and the borrower is making their payments on time, the seller of the loan, meaning the independent mortgage banker, still would have to repurchase that loan. So yes, a loan that is not performing automatically triggers a quality control of that loan. And if there's if the loan was not underwritten in accordance with Fannie Mae and Freddie Mac underwriting guidelines, then the seller has to repurchase it. But
So
there are
let's try
times,
it.
I've had to repurchase loans, even if the loan was performing.
Yeah.
And it's challenging, it's upsetting, but that's the business I chose. So
That's true. So let's dial it to, not, this is, by the way, this is nothing here is a doom and gloom whatsoever. What's happening is, what we're picturing here, or painting here, is that in this market that's so volatile, what makes it a little bit more challenging is that with the changing pricing, with the changing, is it going to be a credit policy issue? You really just have to watch your sources. We have to protect the portfolio, meaning that protect our sources. What source am I referring to? Obviously, number one, your consumer, because ultimately there's something I call looking for affordability, or something what I call if affordability. I'm going to come out on another class on that, but at the same token, we also have to protect the golden goose. What's the golden goose? Our Wall Street investors who securitize these loans, who then attract our global investors to buy those securities. Again, that's what makes this so powerful, why our country is able to offer this near endless source of funds for creating a home ownership opportunity. And that's really what this comes down to. And we're in a market, and that's why I believe that once we slow down a little bit here, okay, your cycles, you're going to have cycles, you're going to have counter cycles. To me, it's the soft landing, or is it going to be crushing inflation? This is what we watch. Is it going to be volatile, or is it going to stop and be kind of direct sailing when things calm down? Either way, is that if you read the markets correctly, we do create opportunity, and that's what it comes down to. I think we all would prefer direct sailing, meaning let's see where we're landing. Are we going to have a soft landing with the feds? Are they going to get inflation under attack? Of course we're going to. But how is it going to get? We just don't know. Maybe we should tune in today to 5 o'clock. We should find out. But the bottom line is, we do eventually land. We do eventually then set the tone so that lenders can make intelligent decisions, and lending will just continue on the way it was. Right now, we're just in that painful cycle. Once it kind of levels off a little bit, I think what we see is that buyers typically chase the bottom when it comes to rates, and sellers chase the top when it comes to the market. And when everything starts coming back, where the market's coming down on the sales end and rates are coming up on the buying end, maybe some more normalcy comes into play, because it's been an abnormal year, I think we could all say. So let's close out here. Terry, thoughts, where we heading? What do you think?
I think your point's a good one, Andy. I think we're closer to the end than the beginning. As in your markets and my markets, we all like some visibility, some level of stability. And, we've probably got another couple of rate hikes here before at least the Fed stops. I think to your point, I think higher rates, prices coming down, perhaps shake some sellers from the tree. So maybe you see some supply in housing coming on the market. That's a possibility. And when you start hearing the recession word, the R word, people start to get a little nervous and feel like, oh gosh, did I miss the peak in selling my home? Right. In terms of Wall Street, we're going to watch over, the next couple of months to see whether or not the Fed is going to pull back in terms of their activities. The challenge that we face is that the Fed was data dependent, and that data comes from last month or 2 months ago.
Yeah.
So the Fed is looking through the rear view window of your car. The markets are looking out the front windshield, right? And so that's why I'm concerned that we may hit some recessionary patches here, because the Fed, looking in the rear view mirror, is going to tighten at a time when the economy is already telling us things are slowing. And that tends to create a slow growth environment. So again, stability is on the way. Your audience will adapt, I'm sure. And we're closer to the end than the beginning. So hang in there.
All right, thank you, Terry and Steve. I'll get your last moment of thought, but my point is, I think wherever we land, we'll do business, and wherever we land, there's always going to be opportunity for home ownership, and that's the truth. We have to look past the headlines to see really what's happening and understand it, and not get afraid of that. And to our real estate community, the opportunities will always be there. It may be a different product. It may rolled out. It might be possibly what we call niche products or specialty lending that might be more relevant that particular time. But the bottom line is there's always opportunity. Steve, 2023, where are we heading, my friend? What do you think?
Well, I echo a lot of what Terry said, and to me, it's just a matter of trying for everyone that's on this call or the audience, just try to stay informed and educated as to what's going on going forward. I think that's important as a realtor and as someone involved in the mortgage banking business. And I always felt that an educated consumer is your best customer, right? And as realtors or as mortgage professionals or as in Terry's field on the security side, it's just important to stay educated so that you can help your consumer make the right decision.
And we do that as an industry too, because an educated professional is their best source as well. And I think that's what it's always come down to. So I'm going to wrap it up and going to thank our participants. And I know if we were in the room together, we would have a great rounding of applause right now. But I'd like to thank Terry. He is a tremendous source and portfolio analyst and working with consumers. He's going to be joining us much more and maybe get to know Terry as an industry professional. Many of you may know Steve already, but if not, also get to know Steve, and he's a wonderful professional as far as I'm concerned, and it's honored to know him and have worked together in the industry for a long time. And I just appreciate your time. I think it was a great event. Let's see where the feds do go, but bottom line is, I think we're in for a great year. I was in the strategy meeting this morning with the Board of Realtors, and I'm about to run to another one for the different committees. And I will say, where I believe this organization, LIBOR, is really steering everything in the right way to create just a fantastic year. So that is the mood. Honestly, get past the headlines, and thank you for joining us today, guys. So all a wonderful holiday, and thank you for joining us.
All right. Thank you, Andy. Thank you, Terry.
Take care, Steve. Thank you.
Mary Ann.
I know.
Thank you.